Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Customers looking for a loan in Australia are spoilt for choice. Competition between the big banks for home loans has been quite incredible. But away from mortgages, the personal lending space has been turned on its head in the last few years by a new breed of fintechs. Companies like ASX-listed Plenty are using technology to provide loans for everything from solar panels to buying an electric vehicle. Daniel Fogo is the co-founder and CEO of Plenty, Australia's largest consumer fintech lender. Daniel, welcome to Fear and Greed.
Morning, Sean. Thank you for having me.
So just give me a thumbnail sketch, the background of Plenty, why you started it.
Well, I actually started the business with my two co-founders, Ben and Glenn, and we came at it from different angles. My background was in finance and investment banking, and I looked at consumer finance and I saw wide spreads, and I saw finance really acting as a friction in our economy as opposed to a lubricant. So, very wide spreads, and I saw an opportunity to just sort of turn that on its head. I think Ben and Glenn, with their technology backgrounds, came from a different perspective. They saw, at least in an Australian context, relatively poor customer experiences, slow credit decision times, and they had a view that we could build a business with technology at its core and turn that around and provide better experiences to our customers. So our different perspectives, I think, mesh together very well.
Okay, so you're very much a disruptor to the traditional banking services in an area which perhaps hadn't seen as much competition, and that's personal loans, as opposed to mortgage loans, where, of course, there's been plenty of competition since Aussie home loans quite a few decades ago. But your area, it was kind of ripe for disruption.
That's right. When we first launched back in 2014, the difference between borrowing rates and deposit rates at our major banks was about 15 or 16%. So very wide margins on an international context, wide enough to sort of drive a bus through, as we used to say.
Yeah. Okay. So what is your basic strategy? What's your competitive advantage? What do you compete on?
Look, fundamentally, our competitive advantage is our technology. We've built our own technology platform that's actually very unique in consumer finance in Australia. We have about 40 people working in product and technology, and it's through that technology that we can deliver better experiences to our customers and our partners and also operate very efficiently. So that's our key point of difference, is the technology we've built.
Okay, so what are most of your customers using personal loans for? Are they refinancing debt? You mentioned EVs and you mentioned solar as well. What about holidays, those sorts of things? What are they using the money for?
Well, we'd describe our purpose as a business is to help bring our customers' big ideas to life. So, whether that's them wanting to buy a car, whether it's wanting to transition to an EV or invest in, equipment to help our environment, through providing finance, we can help bring their big ideas to life. Our origins were in personal loans. That's where we first started. So those, are unsecured loans that will service everything from home improvement to debt consolidation. But our largest vertical now is in automotive finance. It's a very large market, over $35 billion of finance provided every year. We, fund a large number of customers every month, either buying new vehicles or secondhand vehicles. And a really exciting vertical that we're in is renewable energy finance, where we're funding loans for solar panels and home batteries. And in fact, we believe we're the largest funder of home batteries in Australia. So the simple answer to your question is we fund loans for a very broad range of purposes.
Okay, so let's go into those a little bit more, the solar panels and batteries. What's the size of a typical loan?
They're quite modest loans, actually, typically around, or on average, about $9,000. But that masks some variance. If you're just putting a solar panel on your roof, you're typically paying $5,000 or $6,000. If you're putting solar panels and a home battery in, you're typically paying more like $15,000.
Okay.
From our perspective, that's, it's great business. These are typically, or from a credit perspective, these are typically homeowners. They're typically saving money. People who care for the environment tend to repay their loans.
Right, that's interesting. You've also got partnerships with AGL and Energy Australia to help customers finance solar. That's clearly something that they're pushing, but a good way to market for you is to actually work with some of the providers to provide the finance.
That's right. Actually, across our whole business, around 80% of our loans come through working with different partners, be they energy retailers, be they loan brokers or other types of businesses. So that's an important aspect of our business. We have very deliberately started to partner with large energy retailers as a way for us to access customers to provide our finance. And actually, we see quite an exciting future here in working with energy retailers where consumers will be able to buy what we describe as a bundled energy solution. So rather than pay the amount up front to install solar and battery systems, rather they can integrate our finance to cover the cost of that equipment with their monthly energy bill. So with one monthly payment to the energy retailer, they can have a fully fledged renewable energy system and reduce their energy consumption bills. And if you think about a future where electric vehicles are quite commonly owned by households, actually the installation of solar and batteries makes more sense. And again, it makes more sense to think about the consumption of your energy as a household on a more holistic basis. So we see ourselves as having quite an important role to play in bringing all of that together for the consumer.
Okay, you mentioned electric vehicles then. What role are you playing around electric vehicles? The take-up rate in Australia has been quite low so far, but do you presume that will pick up markedly in the next decade or so?
Absolutely. Look, it has been low, and I think a large part of that has actually been constrained supply of electric vehicles. The number of vehicles or EVs that are available in Australia is somewhat lower than what's available in overseas markets. But it is certainly an exciting and growing segment. We really want to have, play an important role in helping Australians transition to EV ownership. What we introduced at the back end of last year to help us in that regard is an EV-specific loan. So first and foremost, that is a loan that has a discounted rate. We can provide a discounted rate to the customer because, for two reasons really. One, we've got relatively low-cost funding ourselves to finance EVs. In part, that's through government funding support through the Clean Energy Finance Corporation. But also, from a credit perspective, EV customers tend to perform much better. So first and foremost, a discounted loan rate, but also really helpful features such as an ability to top up your loan to pay for charging equipment or software upgrades. We've also introduced or launched an agreement with a very significant EV manufacturer where we provide their customers with finance. So bringing all of that together, we think we're very well placed to build really strong market share in the EV market, and we think that market's set for strong growth in itself. So we do expect, over the next 12 or 24 months, the funding of EVs will become a very material part of our business.
Stay with me, Daniel. We'll be back in a minute. My guest this morning is Daniel Fogo, co-founder and CEO of Plenty. Okay, so you've passed $100 million a month in loan origination, so you must be doing something right there, Daniel. Where are those customers coming from? Are you taking them from the big banks mostly?
Look, the answer is yes. We're not funding, new types of people. We're funding the people that historically would have been funded by banks or the likes of VW or Toyota. The majority of our customers own their own home, and often I'm asked, why would people not add finance to their mortgage if they do own their own home? We offer really good value, fast and convenient finance. So it often makes more sense to take out a loan with us and repay it over a shorter period of time and actually save yourself money versus putting it on your mortgage. The average age of our borrowers is about 41, and that often surprises a lot of people for a fintech. They think that we'd be, funding a lot of relatively young customers, but we're actually underweight customers under the age of 30. And I think most importantly, our customers are people who have a good credit history. So our average customer credit score, if you're familiar with that, is over 820, which compares very favourably to the broader market. So the average Plenty customer covers a broad range of people, but with a focus on creditworthy people.
And how much do you cost? Are you much more expensive than the big banks? Because I totally get the whole thing about adding finance to your mortgage. The paperwork is prohibitive and intimidating, shall I say. But at the same time, that is a cheaper loan than presumably what Plenty's offering.
Actually, we offer very competitive financing, and so you can get an automotive loan with us through a manufacturer relationship at the moment from 3%. And you can have
that's less than a half. I mean, I've been through this process with one of my kids recently, and they were getting 6.99% was the loan that was being offered to him.
Yes, and so, we can offer very competitive finance. And I think when we contrast ourselves to banks, you have to look at it on a product-by-product basis. I think our average borrower rate across personal loans does contrast favourably to banks. And similarly, our automotive finance is very competitive. So, we actually think the people who come to us are often people who are looking for a better deal.
Okay, I just want to mention the peer-to-peer lending first. Tell me about that.
Well, that really harks back to the origins of our business. We're now funded in a very diversified way. We have warehouse facilities with two of the major 4 banks in Australia. We've completed asset-backed securities transactions, or one, and about to launch a second. But the origins of our business is absolutely in marketplace or peer-to-peer lending. We've attracted over 20,000 people who have wanted a fixed income return through investing in consumer finance. And we run what we call our marketplace there, where it operates a bit like a stock market. People can sign up and invest from as little as $10, and they can get exposure to the underlying customers that we're funding. We don't set the rates, rather it's the supply and demand of funds that determines the rates. And, it's quite a simple process from an investor perspective. I think an important piece to add here is we have introduced quite an innovative structure where there is a first loss piece, if you like. We call it our provision fund, which is a pool of money that is there to help protect investors in the event of a borrower not repaying their loan. And pleasingly, over the 8 years or so of our operations, all of our investors have received all amounts of principal and interest that are due to them because of that structure. So it is quite innovative, and it's an important part of our funding mix still, the peer-to-peer lending.
So the question for me about Plenty is you've operated and done really well in a falling interest rate environment. Is it the same in a rising interest rate environment, which of course is what we're heading into for the next few years?
Yes, we don't really see the interest rate environment having too material impact on our business. If we think about our existing loan book, which is over $1 billion, we actually hedge that at the end of every month, so our margins are locked in. So when we think about interest rates moving, it's really about, what happens on new originations. And just like any other business, if our input costs change, we obviously expect to be able to pass much of that change on to our customers. So pleasingly, we're seeing some positive dynamics as some funding costs go up. Interest rates are going up for customers as well. Now, clearly, there can be an impact on customers. What happens in a higher interest rate environment? Do people have the same propensity to take out finance? Do they repay more rapidly? I don't think with the sort of rates movements that we're talking about or looking at in our yield curve at the moment, I don't think we should expect to see any material changes on either of those two metrics. In fact, it's typically when interest rates go down that people will look to refinance their loans rather than when rates are going up.
Okay. Any plans to move into home lending?
I think that's the question you always get asked in Australia.
Yeah.
Look, I think the home lending market is obviously competitive. It's already been disrupted. I think our key competitive advantage is our technology, is our ability to very efficiently process lots of loans and provide a very good customer experience. And I query whether that lends itself so much to us moving into the mortgage market. What I would say is, we are growing our originations at over 100% year on year at the moment. We're in very large markets. The overall markets we're in represent about $150 billion of loans outstanding at the moment. And with $1 billion loan book, we've got a long growth runway in front of us, so we don't feel a need to move into a new vertical. But I think by virtue of the fact when you employ a lot of people who love working on innovative things, who are entrepreneurial by nature, you can't help explore new opportunities and new verticals to move into. So I do anticipate we'll continue to broaden out our offering, but query whether that's mortgages or something else that we will expand into.
That sounds like a never say never answer, Daniel.
That's probably a good description of it, yes.
Fair enough. Thank you for talking to Fear and Greed.
Thank you very much for taking the time. Appreciate it.
That was Daniel Fogo, co-founder and CEO of Plenty. This is a Fear and Greed daily interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.